Very happy morning to all. So we are going to do today a brilliant, fantastic topic called as MAT, Minimum Alternate Tax. Sir, 115 JB is the section. 115 JB subsection 1 is saying that notwithstanding contained in any other provision of the Income Tax Act, where in case of a company, that company may be a foreign company or domestic company. That means MAT provisions are applicable to both foreign company and domestic company. When we see the format also, my dear lovable students, sir, any income earned by the foreign company on account of IFRS. அப்போ income earned by the foreign company na foreign company ki MAT provision apply ஆவறதுனால தானே அந்த formatல any income earned by the foreign company னு கொடுத்திருக்காங்க. அப்போ notwithstanding anything contained in any other provision of the Income Tax Act, where in case of company, that company may be either domestic company or foreign company, the income tax payable on total income as computed under the Income Tax Act in respect of any previous year relevant to the assessment year or subsequent assessment year is less than 15% of the book profit. That means if you are a company, my dear lovable students, you have to calculate the tax payable as per the normal provision. If the tax payable as per the normal provision is less than 15% of book profit, how to compute the book profit? As per 115 JB. So, if the tax payable as per the normal provision is less than 15% of book profit, then such book profit shall be deemed to be the total income of the assessee. And tax payable on such total income shall be amount of income tax at the rate of 15%. Brilliant to the core. So, what they are trying to say, my dear lovable students? Are you a company, domestic company, foreign company? You have to calculate two tax payable. Tax payable as per the normal route, tax payable as per the MAT route. If the tax payable as per the normal route is less than 15% of the book profit, then 15% of the book profit will be treated as the tax payable by the company, and book profit will be treated as the deemed total income. Book profit will be treated as the deemed total income. My dear lovable students, for a company located in IFSC which derives its income solely in convertible foreign exchange, the rate of MAT will be 9% instead of 15%. Up in case company IFSC kulla irukana, concessional MAT rate of 9% will be applicable. What is the one line summary, sir? In case of company, MAT will be applicable only in case of company, whereas AMT will be applicable for other than company. If the tax payable under the normal route is less than the tax payable under the MAT route, then the book profit will be treated as deemed total income, and tax payable will be MAT payable. So, if the assessee is a company, as per section 115 JB subsection 1, you have to calculate, my dear lovable students, tax payable as per the normal provisions of the Act and tax payable as per MAT route. If the tax payable as per the normal provisions of the Act is less than 15% of the book profit, then book profit has to be treated as the adjusted total income, and the tax payable will be MAT payable. With this background, I am moving into 115 JB subsection 2, preparation of P&L account. Because the starting point of the MAT is net profit as per P&L account. Clear? So, how to prepare that P&L account? Every assessee being a company, other than the company referred in clause B, we will be talking this clause B, shall, for the purpose of this section, prepare its statement of P&L, profit or loss for the relevant previous year in accordance with the provisions of Schedule 3 to the Companies Act 2013. That means you have to prepare the P&L account as per Schedule 3, my dear lovable students. So, being a company other than a company referred in clause B, so this is separate company. For them, Schedule 3 will not be applicable. For them, the applicable financial reporting framework is something different. So, if the company is a normal company, you have to prepare the P&L account as per Schedule 3 of the Companies Act 2013. Whereas the company is an abnormal company, that is special company, being a company to which the second proviso to 129 subsection 1 of the Companies Act is applicable. For the purpose of this section, prepare its statement of P&L for the relevant previous year in accordance with the provisions of the Act governing such company. That means they have to prepare the P&L account in accordance with the provisions of the Act governing such company. That means banking company means Banking Regulation Act. Insurance company means IRDA. Electricity company means Electricity Act. So respective act will be applicable, my dear lovable students. Provided that while preparing the annual accounts including statement of P&L, the accounting policies, the accounting standards adopted for preparing such accounts including statement of profit and loss, the method and rates adopted for calculating the depreciation shall be same as have adopted for the purpose of preparing such accounts including statement of P&L laid before the company at AGM in accordance with section 129 of the Companies Act 2013. So what in the proviso they are saying, if that company when they are preparing that P&L account, whether either as per Schedule 3 or the applicable financial reporting framework, the accounting policies, when you whatever you adopted when you prepare the P&L, accounting standards or the methods and rates adopted for calculating depreciation should be same what is mentioned in the, my dear lovable students, section 129 of the Companies Act. Appo 129 of the Companies Act 2013 la neenga books of accounts AGM la vekkumbodhu இந்த accounting policy, இந்த accounting standard, இந்த methods and rate அப்படி நீங்க சொல்லிருப்பீங்க. So the same should be there. This is how you have to prepare the P&L. So what is the one line summary of whatever we are discussing? In case of a domestic company or foreign company, they have to calculate the tax payable both under the normal route and also under MAT route. If the tax payable under the normal route is less than the MAT route, then the book profit will be deemed as the total income. Point number 1. Number 2, and the tax payable will be MAT payable. My dear lovable students, 115 JB subsection 2. What they are saying? Are you a normal company or abnormal company? That means special company. If you are a normal company, then you have to prepare the P&L account in accordance with the Schedule 3. Whereas if you are an abnormal company, my dear lovable students, then you are supposed to prepare the schedule, your P&L account in accordance with the respective statute. I'm moving to the next one. Below that there was one proviso. That proviso is ensuring that you have to prepare the P&L account with the same accounting policy, with the same accounting standard, with the method and rates adopted for calculating the depreciation as per section 129 of the Companies Act. I'm moving to explanation number 4 to 115 JB subsection 2. Non-applicability of 115 JB for certain foreign company. Oh my God. We understood that MAT will be applicable for foreign company, but for this two foreign company, sir, MAT provisions will not be applicable. The assessee is a resident of country or a specified territory which India has double taxation avoidance agreement under 90 or 90A. And the assessee does not have a permanent establishment in India in accordance with the provisions of such agreement. Brilliant. At this point of time, this point we should be able to appreciate or understand very beautifully. For example, there is one company in India. Actually, they are resident of Germany. There is India-Germany, sir, double taxation avoidance agreement. And this German company does not have a permanent establishment in India as per article number 5 of the Model Tax Convention. Then without, sir, permanent establishment in India, business profit cannot be taxed in India. So that provision is not only applicable to the normal provisions of the Act, but also applicable to the MAT. This point is applicable. So the assessee is a resident of a country or a specified territory with which India has double taxation avoidance agreement. Under section 90 or 90A, an assessee does not have a permanent establishment in India in accordance with the provisions of such agreement. Or assessee is a resident of country with which India does not have double taxation avoidance agreement. Or assessee is a resident of country. With that country, India does not have a double taxation avoidance agreement, and assessee is not required to seek registration under any law for the time being in force relating to company. In India, that company is not liable to take registration in India. They may be a Section 8 company or charitable purpose company or any company who are not liable to take registration in India. Then the provisions of 115 JB will not be applicable. So 115 JB not applicable to two foreign company. Foreign company is a resident of country or specified territory where India is having DTAA, and that country does not have a permanent establishment in India as per that DTAA. Or foreign companies are resident of country where India does not having DTAA, and foreign companies not required to take registration in India. I am moving to the next one. Explanation 4A to section 115 JB subsection 2. For the removal of doubts, it is hereby clarified that provisions of this section shall not be applicable. Again, non-applicability. So the above non-applicability is applicable to foreign company. Now I am coming to general non-applicability. And shall be deemed never to have been applied to an assessee being a foreign company where its total income comprised solely of profits and gains from business referred to 44B. We know that presumptive taxation. 44B means shipping business of non-resident. So if you are an assessee, sir, whose income is going to be taxable under 44B, my dear lovable students, 44B, the specified rate is 7.5%. If it is 7.5%, why are you charging IST levy of 15% MAT? So for 44B company, MAT provisions will not be applicable. Then 44BB is hiring of meats, plant and machinery for extraction of mineral oil. This is also applicable to a non-resident. The rate is 10%. 44BBA, operation of aircraft. Operation of aircraft is applicable to non-resident. 5% is the specified rate. Then 44BBB, that is turnkey power project. For turnkey power project is applicable to non-resident. The tax rate applicable is 10%, and such income has been offered to tax at the rate specified in those sections, which is 7.5, 10%, 5%, 10%. That means if the assessee has declare the income in accordance with the presumptive route, then the MAT provisions will not be applicable, because those presumptive route are much concessional than the MAT at the rate of 15%. That's why explanation 4A to section 115 JB subsection 2 is saying that for such a foreign company, the MAT provisions will not be applicable. I'm moving to the other provisions of the MAT. Section 115 JB, carry forward of losses and depreciation. Nothing contained in 115 JB shall affect the determination of amount in relevant previous year to be carried forward to subsequent year or years under the provision of 32, which is unabsorbed depreciation, 72 normal business loss, 73 speculative business loss, 74 capital loss, or 74A, sir, loss from owning and maintaining resources. That means, sir, what is the purpose of MAT? The MAT is only for the purpose of payment of tax, nothing to disturb with the carry forward of loss. But you may argue to me that carry forward of loss has been determined in accordance with the normal provisions of the Act. Upon the loss any carry forward paniko, and the loss carry forward பண்றதுக்கும் MAT-க்கும் சம்பந்தமே கிடையாது. My dear lovable students, MAT is if the tax calculated as per the normal provisions is less than the tax calculated as per the MAT route, then the book profit will be deemed to be the total income, and tax payable shall be MAT payable. Otherwise, it is not disturbing the normal provisions of the Act. So company can carry forward of loss and depreciation to the extent it could have carried forward 115 JB not there. 115 JB இல்லேனா எப்படி நார்மலா லாஸ் கேரி ஃபார்வர்ட் பண்ணிருப்பாங்களோ, the same way the company can carry forward even though they are traveling through the 115 JB route. Next one, 115 JB subsection 4, furnishing of report. Every company to which this section apply shall furnish a form from a chartered accountant in form number 29B. certifying that from the book profit has been computed in accordance with the provisions of 115JB, and such report shall be furnished before the specified date, that is 1 month prior to the due date of filing the return of income under section 139 subsection 1. So my dear lovable students, sir, for you the provisions of MAT is applicable. How to check whether the tax payable under the normal route is less than the tax payable under the MAT route? Then you have to get a certificate from a chartered accountant in form number 29B, saying that I have computed the MAT in accordance with 115JB. Section 115JB, applicability of other provisions of Income Tax Act. Sir, once you travel through 115JB route, does it mean that advanced tax provisions will not be applicable? TDS, TCS provisions will not be applicable, save as otherwise provided in this section. All other provisions of this act shall apply to every company mentioned in this section. Therefore, the company which MAT applies shall be liable to pay advance tax, interest under 234A, 234B, 234C. Company shall also be liable to pay penalty for concealment of income like 270A, which is underreporting or misreporting of income. Yes, sir. My dear lovable students, that means, sir, MAT is only for the purpose of payment of tax. Tax கட்டறதுக்கு MAT யூஸ் பண்ணிக்கோ. MAT ரூட்ல டிராவல் பண்ணேன்னு சொல்லிட்டு other provisions of the Income Tax Act குப்பையில போட வேண்டிய அவசியம் இல்லை. Section 115JB subsection 5, a MAT not applicable to certain company. Provisions of 115JB shall not apply to any income accruing or arising to a company from life insurance business referred under 115B, because for a life insurance company it is only 12.5% is the presumptive rate, which is less than 15%. When we talk about assessment of various entity, we have talked about, sir, assessment of life insurance business. Fantastic to the core. And person who has excised the option referred under 115BAA, concessional rate of tax, or 115 baby company, newly started company, sir, that is again concessional rate of tax. Sir, once you decided to travel through concessional rate of tax, the provisions of MAT will not be applicable. So 115BAA and 115 baby company, MAT provisions will not be applicable. So MAT not applicable to life insurance business. The logic is they will be paying tax only at a concessional rate of 12.5%, and company opted tax under 115BAA, concessional rate of tax, and company opted under 115BAB, that is again concessional rate of tax. So these are the non-applicability of MAT. We all are well versed with the format of the MAT. Net profit as per P&L account, IRS will get depreciated. Yes, sir. Income tax paid or payable, reserves created by whatever name called, set aside for uncertain liability, dividend paid or payable, diminution in the value of asset, depreciation, deferred tax, expenditure incurred under section 10, 11, 12, expenditure incurred by a foreign company on account of IFRS and capital gain, expenditure incurred to earn income from AOP or BOI covered under section 86, expenditure incurred to earn royalty covered under section 115 BBF, provision for loss of subsidiary debited to P&L account. We will get the subtotal. Yeah, sir, less tired, TIRED, tonnage tax income, income covered under section 10, 11, 12, income earned by a foreign company on account of IFRS and capital gain, income earned from AOP or BOI covered under section 86, income earned from royalty covered under section 115 BBF, reserves withdrawn, depreciation excluding revaluation reserve, and deferred tax, brought forward business loss or unabsorbed depreciation as per books, whichever is lower, you will get the book profit under 115JB. Fantastic to the core. Sir, here we are having a detailed format, computation of book profit, line by line item. This and all will be reading when we start doing the problems, my dear lovable students. In that, sir, for computation of book profit, the book profit shall be increased by the following amount. That means these items should be added back. If the following amount referred in A to I is debited to statement of P&L. If these items are debited to P&L, these items should be added back. Number one, income tax. Income tax is not an allowable expenditure even under the normal route. So the same will not be allowed as deduction when you are calculating the MAT route, because na calculate pandrede income tax payable evlonda. So that amount cannot be debited to P&L account. Income tax paid or payable and provision thereof. So income tax paid, income tax payable, provision debited to P&L account should be added back. It may be noted that income tax includes interest, surcharge and cess. interest, surcharge and cess, that is health and education cess. So income tax include isku. I stands for interest, S stands for surcharge and C stands for cess, which is 4% health and education cess. Fantastic to the core. Amount carried to reserves, amount carried to any reserve by whatever name called, because which is not a charge against the profit, which is an appropriation of profit that cannot be debited to P&L account. If any appropriation of profit has been debited to P&L account, should be added back. Then provision, sir, amount set aside for provision for meeting liability other than ascertained liability. That means provision for ascertained liability are allowed. Provision for unascertained liability means you have debited to P&L account just to reduce the net profit, should be added back. Provision for loss of subsidiary company, it is their loss, subsidiary company loss. Why we have to debit in that in our P&L account? It is their loss. Let them debit to P&L account amount for provision for loss of subsidiary company. This is not consolidated financial statement to adjust their loss. It is our loss only should be there, my dear lovable students. And you have created a provision for loss of subsidiary company, should be added back. Dividend, amount of dividend paid or proposed, sir, either dividend paid or proposed dividend. My dear lovable students, with regard to dividend, it's an appropriation of profit. It is not a charge against the profit. So if any dividend has been debited to P&L account, should be added back. Expenditure relating to exempt income, amount of expenditure relating to any income covered under section 10, 11 and 12 apply. Anyway, section 10 are exempt income. If you credited to P&L account those exempt income, net profit would have been increased, right, by section 10, section 11, section 12. This income you are not going to suffer the MAT because you will remove this item because of credited in the P&L account. So the corresponding expenses relating to section 10, 11 and 12 debited to P&L account should be added back, because anyway you are not going to give us MAT for that amount credited to P&L account. Then whatever amount debited to corresponding expenses debited to P&L account should be added back. And we are well versed with section 11 and 12. Section 11 and 12 is applicable to charitable trust or religious trust. Sir, this is a company who are doing business. If they are having any charitable income, then that has to be removed from the net profit because it is not their business income. And in order to get that charitable income, if they have incurred any expenses, which is application, and if that application has been debited to P&L account, should be added back. That story and all will not be applicable for the company. Brilliant to the core. Expenditure relatable to share of assessee in income of AOP or BOI. That means in your P&L account, by income from AOP or BOI credited will not suffer tax, because these AOP or BOI are liable to pay tax at MMR. Once the AOP or BOI pays tax at MMR, what else you are supposed to be taxed in the hands of the company? Are you again levying MAT? Because already AOP or BOI is suffering tax at MMR. Yes, sir. So if any income derived or received from AOP or BOI credited to P&L account, we will remove. So the corresponding expenses should be added back. Amount of expenditure relatable to income being share of assessee in the nature of AOP or BOI, on which no income tax is payable in accordance with the provisions of 86. What is the provision of 86? If the AOP or BOI suffered tax at MMR, we can say that they have suffered tax at MMR. Then the corresponding expenditure incurred to earn that income should be added back. Super fantastic to the core. Expenditure relatable to income accruing to a foreign company. Brilliant to the core. The amount of expenditure relatable to income accruing or arising to an assessee being a foreign company. Here typically the assessee should be a foreign company. For example, I am a foreign company. For foreign company, sir, the provisions of MAT is applicable. Yes, except to foreign company who does not have a permanent establishment in India or who is not liable to take registration in India. All the other guys are liable to take, sir, pay MAT in India. But I am a foreign company, then from capital gain arising on transaction in securities. capital gain arising transaction securities or interest, dividend, royalty, fees for technical services chargeable to tax at the rate specified in chapter 12, that is section 115A. 115A. So we know that the dividend, royalty, sir, interest, fees for technical services, sir, if the income tax payable thereon in accordance with the provisions of this act other than the provisions of this chapter is at a rate less than 15%. That's what the logic is all about. We are charging MAT at 15%. Any income which are covered under 115A is going to be taxed at a tax rate which is less than 15%. And if that capital gain or if that IFRS interest, fees for professional or technical services, royalty or any other similar sum. What the IFRS or meaning? So, interest, fees for professional or technical services, royalty or any other similar sum credited to P&L account. We will not levy MAT on that because sometimes that capital gain may be covered under 112A and it will be taxable at a concessional rate of 10%, which is less than 15%. Why are you again suffering MAT on that? So, we will exclude that. Since we are excluding that income, corresponding expenses debited to P&L account should also be added back. Brilliant to the core. The next one, amount representing notional loss on transfer of a capital asset. And with regard to this point, you may have a doubt. Sir, as per the new Finance Act, fees for professional or technical services which are covered under 115A subsection 1 clause B is taxable at 20%. Are we supposed to be reduced? My dear lovable students, the checkpoint is the taxing rate. Is it less than 15%? Then you have to remove and you have to add back. Otherwise, don't touch it. Amount representing notional loss on transfer of capital asset. The amount representing notional loss on transfer of capital asset being share of SPV to a business trust in exchange of units allotted by trust referred in clause 47 clause 17 or the amount representing notional loss resulting from any change in carrying amount of said units or amount of loss or transfer of unit allocated in 47 clause 17. That means, sir, we know that, sir, unit holder will be there. Unit holder will invest in REIT. REIT will invest in SPV and the SPV will invest in developmental properties. Yes, sir. Super, sir. My dear lovable students, with regard to this unit holder will invest in REIT. REIT has to hold the shares in SPV. SPV shares sometimes would have been held by the outsiders. So what they will do, whatever shares held by the SPV will be given to the REIT and the REIT will issue units. REIT will issue units to the SPV. Units கொடுப்பாங்க. And the time that the company would have calculated the notional loss and that notional loss would have been debited to P&L account. That notional loss should be added back because it will not be regarded as transfer in the hands of the transferor as per section 47 clause 17. So amount representing notional loss on transfer of capital asset being share of SPV. அப்ப நான் முன்னாடி SPV ஓட ஷேர் வச்சிருந்தேன். To a business trust நான் the REIT கொடுத்தேன். எதுக்காக? In exchange of unit allotted by the trust. எனக்கு REIT unit allot பண்றாங்க. Refer to in 47 clause 17 or the amount representing notional loss resulting from any change in carrying amount of the said units or the amount of loss on transfer of the units allotted in clause 47 clause 17. So any notional loss relating to this exchange, because I was holding the shares of the SPV, I have given that shares and I have got the units of the REIT, my dear lovable students. Sir, then, my dear lovable students, that notional loss debited to P&L account should be added back and notional gain credited to P&L account should be reduced because we don't want MAT on the notional item. Amount of expenditure relatable to income referred under 115 BBF. This we have already talked, 115 BBF. This will be taxable at a concessional rate of 10%. If that income is going to be taxed at a concessional rate of 10%, my dear lovable students, then then why are you levying MAT on that? Because MAT rate is 15%. The amount of expenditure relatable to income by way of royalty in respect of patent chargeable to tax under 115 BBF. And when we talk this topic, we have studied that at least 75% of the expenditure should be incurred in India. So in order to earn that royalty income, you would have incurred certain expenditure, and that expenditure would have been debited to P&L account. Anyway, that income is a special income which is going to be taxed at a concessional rate. For that, anyway, you will not apply the provisions of MAT. So when you remove that item from the P&L, please add back the corresponding expenses also. Brilliant to the core. Depreciation, amount of depreciation. Amount of depreciation means company means, sir, depreciation as per the Companies Act would have been provided. So that depreciation would have been debited to P&L account, should be added back. And you may have a doubt that, oh, are we going to reduce the depreciation as per the income tax rules? No, because that is as per the normal provisions of the Act. This is MAT route. Then for what purpose we are adding back the depreciation? Sometimes that depreciation debited to P&L account may include depreciation on revaluation. That is a cheating. That is not allowed by Income Tax Act. So you should add back the whole depreciation, and you have reduced the depreciation excluding revaluation. With regard to deferred tax, amount of deferred tax and provision thereof. Any deferred tax debited to P&L account should be added back, because deferred tax you are creating in your books of accounts to reduce the timing difference as per your AS number 22. You are calculating the profit as per the books of accounts, as per income tax and also the accounting. Surely the profit will vary because of certain differences. So in order to have a straight line approach of taxes, you are creating the deferred tax that will not be allowed while calculating the MAT, because whatever income tax debited to P&L account we have added back. Provision for income tax we have added back. Deferred tax is also a part and parcel of the income tax, added back. Provision for diminution in the value of any asset. Amount set aside as provision for diminution in the value of any asset. So you are creating some provision for diminution in the value of asset, should be added back. Because if these items and all allowed to be debited to P&L account, my dear lovable students, then you will create so much of unnecessary provision just to reduce the net profit, to escape from the MAT, should be added back. Amount standing in the revaluation reserve. Sometimes, you know one thing, in our balance sheet liability side, there may be revaluation reserve. You would have sold that asset also. And once you sold that asset, my dear lovable students, its profit or loss you will be reflecting in the P&L account. But the amount balance available in the revaluation reserve, you will never bring to the P&L account by a revaluation reserve. This is a wrong practice. And asset on the profit or loss மட்டும் P&L adjust பண்ணிப்ப, especially loss வந்து adjust பண்ணிப்ப. ஆனா revaluation reserve balance sheet ஓட liability sideல நிக்குதுன்னா அத P&L account ஓட credit sideக்கு transfer பண்ணி நீ close பண்ண மாட்ட. அப்படினா my dear lovable students, any amount standing to the credit of the revaluation reserve should be added to the net profit as if it has been credited to the P&L account. Amount of gain arising from transfer of units of business trust. When the units of business trust are actually transferred, business trust na REAT oda units உண்மையிலேயே transfer பண்ற, the amount of gain on such transfer has to be added to the computing the book profit. Since a notional gain on transfer of share of SPV to a business trust in exchange for the unit of business trust, and notional gain resulting from change in carrying amount of such unit would have been deducted to compute the book profit. The amount of gain on such transfer, if any, credited to statement of P&L account, and loss in the year of transfer will also be reduced. For example, sir, I were holding the shares of SPV. Now, sir, I got the units of the REAT. Tomorrow, you are selling that units. Is the loss or gain actual or notional? Notional means add back, and sir, notional gain means reduce. But if it is not notional, you have actually sold the units of the REIT, then in the hands of the SPV, the company, my dear lovable students, or the shareholder who invested in the units of REIT, they have to add or less the actual profit or loss. So notional should be avoided, actual should be considered. In case where the shares are carried out at cost, the amount of gain has to be computed by taking into consideration the cost of shares exchanged with the units of business trust. In case where the shares are carried out value other than cost through statement of P&L, the carrying amount of shares at the time of exchange would be taken into consideration for computing the amount of gain. These items and all will be doing in the sum. That's what, for that only we are moving. The profit shall be reduced by the following. That's it. So these are the items debited to P&L account. If these items debited to P&L account should be added back, but these items has to be reduced. Amount withdrawn from any reserve, because any amount reserves created by whatever name called debited to P&L account, you are adding back. That means in the year of adding back itself, you are suffering the MAT. But in the year of withdrawal, my dear lovable students, if you are allowing to be there in the credit side of the P&L account itself, then you know what will happen? Net profit will increase. All that increased net profit, if you suffer MAT, it will lead to double taxation. It should not happen. So amount withdrawn from any reserve or provision, if any such amount is credited to the P&L account. However, amount withdrawn from reserve or provision shall not be reduced from the book profit unless the book profit of that year has been increased by those reserves and provision. So you have to check what was the status in the year of creation. In the year of creation, if you have added back, my dear lovable students, then at the time of withdrawal, no need to include in the net profit. Fantastic to the core. Sir, in the year of creation, it has not been added back. That means you have not created the reserve through the P&L account. You have created the reserve through the balance sheet. From the P&L, you have transferred to the general reserve. Tomorrow, you are withdrawing from the general reserve. So, you have not suffered MAT in the year of creation. Then it will be taxable in the year of withdrawal. Exempt income, any amount of income to which section 10, 11, 12 apply. If any amount is credited to the statement of P&L, because these guys are exempted. If the income are exempted, why are you talking about 15% MAT? So exempt income should be reduced. Depreciation, amount of depreciation debited to statement of P&L can be reduced, excluding the claim of depreciation on account of revaluation of the asset. But if that depreciation debited to P&L account includes revaluation of asset, my dear lovable students, that will not be allowed, because you have revalued the asset only for the purpose of increasing the depreciation to reduce the net profit. So whatever depreciation debited to P&L account, we will add it back. We know that that depreciation is as per Companies Act. We don't have that problem. We are not saying that add back the depreciation as per the Companies Act and reduce the depreciation as per the Income Tax Act. No, no such concept, my dear lovable student. I am adding back the depreciation for the purpose of, sir, removing the depreciation on account of revaluation. Amount withdrawn from revaluation reserve. So, amount withdrawn from revaluation reserve and credited to the statement of P&L to the extent it does not exceed the amount of depreciation on account of revaluation of asset. That means if you are withdrawing any amount from the revaluation reserve to the extent it does not exceed the amount of depreciation on revaluation of the asset. What is this point? We'll be explaining below separate question. Share of assessee in the income of AOP or BOI. Because AOP or BOI already suffered tax at MMR, then why are you again levying 15% MAT in the hands of the member? Then it will be sir, too much of tax. The amount of income being share of income from AOP or BOI on which no income tax is payable in accordance with section 86. If any amount is credited to P&L, it should be reduced. The same thing, income accruing to foreign company, counter things. Amount of income accruing or arising to an assessee being a foreign company from capital gain arising on transaction securities, because that capital gain may be taxable only at the rate of 10% or only at the rate of 15%. The interest, dividend, royalty, fees for technical services, which is IFRS, chargeable tax at the rate or rate specified in chapter 12, that is 115A. If such income is credited to P&L account and the income tax payable thereof in accordance with the provisions of this act other than the provisions of chapter 12B is at a rate less than 15%. So if any income is going to be taxed at a concessional rate which is less than 15%, my dear lovable students, then that income has to be removed while calculating the book profit. Notional gain on units of business trust. We are not interested in the notional gain or notional loss. So that notional gain on exchange should be removed. Notional loss on exchange should be added back, whereas actual gain we want. The amount representing the notional gain on transfer of capital asset being a share of a SPV to a business trust in exchange of unit allotted by the business trust, or notional gain resulting from any change in the carrying amount of said unit, or gain on transfer of such unit if any credited to the statement of P&L. Income by way of royalty covered under section 115 BBF, because that royalty income is going to be taxed at a concessional rate of 10%. So why are you levying MAT and killing the company? So amount of income by way of royalty in respect of patent chargeable to tax under 115 BBF, brought forward business loss or unabsorbed depreciation. Brought forward business loss or unabsorbed depreciation. Brought forward business loss and unabsorbed depreciation. So two scenarios are there. Aggregate amount of unabsorbed depreciation and loss brought forward in case of company and its subsidiary and subsidiary of such subsidiary, where the tribunal on an application moved by the central government under 241 of the Companies Act has suspended the board of directors of such company and has appointed new directors who are nominated by central government under 242 of the said act. Company against whom an application for corporate insolvency process has been admitted by the adjudication authority under section 7 or 9 or 10 of the Insolvency and Bankruptcy Code. It may be noted that loss does not include depreciation. So a company would be subsidiary of another company if such other company holds more than half in the nominal value of equity share capital of the company. So brought forward business loss or unabsorbed depreciation, and brought forward business loss and unabsorbed depreciation, two concepts are there. So my dear lovable students, the amount of brought forward business loss or unabsorbed depreciation, whichever is lower in case of other company as per books of accounts. Here brought forward business loss and unabsorbed depreciation. That means you have to classify the company into two categories. So company into two categories. Number one, normal company, and number two is company who has IBS, corporate insolvency they have applied. If it is normal company, brought forward business loss or unabsorbed depreciation as per books, whichever is lower. Whereas with regard to any company whose directors has been changed by the central government, that means basically a fraud company, or whose insolvency and bankruptcy code is applicable, then brought forward business loss and unabsorbed depreciation as per books, whichever is lower. So here it is or. So amount of brought forward loss or unabsorbed depreciation, whichever is lower in case of other company as per the books of accounts. The loss shall not include depreciation if either the figure of brought forward business loss or unabsorbed depreciation is nil. Idhila edha 1 0 achana, no deduction will be allowed from the book profit of the relevant year. Profit of sick industrial company, the amount of profit of sick industrial company commencing from the previous year in which the company becomes sick and ending with the assessment year during which the entire network of such company become equal to or exceed the accumulated loss. For this purpose, network shall have the same meaning as assigned in something of the sick industrial act. That means this also has to be reduced. Profit of the sick industrial company. Company ke kaachal vandirukku, yampa MAT vaangi avanga ICU la poi saavadikara. Profit for the sick industrial company is not subject to MAT and the deferred tax. Amount of deferred tax, if any such amount is credited to the statement of P&L account, that is deferred tax asset and deferred tax liability, we don't want MAT because it is only a timing difference. You are only creating to bridge the difference between the accounts and tax. So my dear lovable students, if these items has been credited to P&L account, then you should not, sir, tax this item for the purpose of MAT. This is the formatting detail of the MAT, and you know one thing, we are going to analyze the format. Deferred tax பத்தி நம்ம தெளிவா பேச போறோம். Then expenditure relating to foreign company பத்தி நம்ம பேச போறோம். From there we are going to do a question also, my dear lovable students. Then we'll be doing the amount withdrawn from revaluation reserve பத்தி பேச போறோம் நம்ம. Then from that there one summary is there, illustration is there, and also sir, after that illustration, analysis of the another clause, brought forward business loss or unabsorbed depreciation, profit of sick industrial undertaking. Once I done that analysis, you will be having a 1000 clarity from the format of MAT. Then this question, the MAT question which is 10 mark for examination, is a cakewalk for you. So have a revision of up to this. This is part number 1, which is introduction to the MAT, which is purely theory area. Have a read of it. Then come to the analysis of that. We'll be killing that part with logic. We'll be start doing the provisions from the MAT. Then we can say that this 10 mark of MAT will comes to an end.